The Federal Reserve just told Wall Street it isn't going to save it. And within a few hours, the Dow bled more than 1,000 points. That's not a market having a bad afternoon. That's a market realizing the referee changed the rules and didn't bother to send a memo, because the numbers matter here. And the numbers are the story. On July 29th, Kevin Warsh's Fed voted 9-3 to hold the benchmark rate right where it was, in a range between 3.5% and 3.75%.
3 regional presidents dissented: Cleveland, Minneapolis, and Dallas.
And here's the part that should make you sit up in your chair. They did not dissent because they wanted cuts. They dissented because they wanted to hike. They wanted rates higher. Inflation has now run above the Fed's 2% target for more than 5 years straight. 5 years. That's not a blip, that's a regime. The core PCE index, the Fed's own favorite gauge, the one they swear by, actually accelerated from 3% in December to 3.4% by May. It's going the wrong direction, and a big slice of that is energy. West Texas crude went from around $57 a barrel at the start of the year to a peak of $113 in April. Nearly doubled. When the input cost of everything doubles, you don't need a PhD to know where prices are headed. So the Fed holds, and the market doesn't read that hold as patience. It reads it as a central bank that's behind the curve. The day before the decision, this is the CNBC number, the Dow closed 1,153 points lower, 2.19%. Its worst single day since April of 2025. The S&P dropped 1.5%. The Nasdaq fell 1.7% and closed more than 10% off its all-time high. Let me translate that last one, because people gloss over it. 10% off the high has a name. That name is correction. The Nasdaq walked into correction territory, out loud, on the day the Fed said everything's fine. Now here's the tension. And I want you to pay very close attention to who is telling you what, because this is where the spin lives. The official framing, the one U.S. Bank and the Fed itself are quietly pushing, is that Warsh is being disciplined. He's the adult in the room. He called inflation a choice. He's stripped the Fed's statement down to the studs, killed the forward guidance, stopped spoon-feeding the market its next move. He's even set up a task force, specifically about how the Fed communicates. And there is a version of that story where Warsh is a hero, the guy who finally makes the central bank stop babysitting traders and playing therapist to the stock market. But let me be direct about this, because somebody has to be. Discipline and drift look absolutely identical, right up until the moment they don't. And by the time you can tell them apart, it's usually too late to do anything about it. Here's the second reading, and I think it's the more honest one. Warsh got nominated back in February, and the entire reason markets got excited about him was the expectation that he would cut. One economist at Brookings was out there calling for 100 basis points of cuts this year, a full percentage point. The whole Warsh trade was built on easier money coming. Then you layer on the politics. President Trump has been publicly leaning on Warsh to slash rates. At the White House, it's been a constant drumbeat. Asked if he was disappointed, Trump said Warsh would love to cut, but, quote, he's got a board, and it's a political board, and they want to keep rates up. Sit with what that actually is for a second. That is a sitting president standing at the White House, narrating the Fed chair's private internal struggle in public, and framing the officials who want to fight inflation as the political ones. Flip it around, the people trying to hold the line on prices get called political, and the guy demanding cheap money right before the midterms is the reasonable one. That's not pressure around the edges. That's pressure with a spotlight and a microphone on it. So which Warsh are we actually getting? The independent inflation hawk who'll take the pain? Or the guy who got installed on the promise of cuts, who's now trapped between a president who wants easy money and a bond market that is screaming easy money is exactly how you lose control of prices? Here's my take, and I'll defend it. The sell-off isn't a tantrum. Traders didn't throw a fit because they didn't get their candy. The bond market is pricing in something scarier. The possibility that nobody at the Fed actually has both hands on the wheel. You've got 3 officials who want to hike, a chair who campaigned on cutting, and a president tweeting through the whole thing when the 10-year and the 30-year yields jumped the way they did. the 30-year up more than 9 basis points in a single session. That is not investors worried about one meeting. That is investors worried about credibility. And credibility is the only product a central bank actually sells. The Fed doesn't make anything. It doesn't sell widgets. The only thing it has is the market's belief that it will do what it says. The second that belief cracks, everything they touch gets more expensive. Your mortgage, the government's debt, corporate borrowing, all of it. Here's the line I'll leave you on for this one. A Fed that refuses to tell you where it's going had better be dead certain it knows itself. Right now, I'm not convinced it does. And an uncertain Fed is a far more expensive thing to own than a wrong one. Now, let's talk about the companies that are supposed to be immune to all of it. The ones with so much cash they could survive a nuclear winter. And why, this week, even they weren't safe. Because while the Fed was busy spooking the bond market, the biggest names in tech were quietly proving that even a $1 trillion balance sheet can't buy you a free pass anymore. Here's the setup, and the number is genuinely staggering. The 4 biggest spenders, Amazon, Alphabet, Meta, and Microsoft, are on track to spend a combined $725 billion on capital expenditures this year. $725 billion. That's a 77% jump from last year. And the overwhelming majority of it is AI, data centers, chips, the physical guts of the machine that everybody's betting the entire next decade on. To put that in perspective, that's one of the largest coordinated corporate investment programs in the history of capitalism, and it's being deployed in the span of 12 months by 4 companies, all pointed at the same bet. And this earnings week, Wall Street finally stood up and asked the question out loud, the one it had been too polite to ask. Okay, where's the money? Where's the return? And I want you to watch how differently the market treated companies that reported almost identical quarters. Because the pattern tells you everything. Start with the winners. Microsoft jumped roughly 8%. Why? Because when it reported $41 billion in quarterly Azure CapEx, it defended that number by pointing to real, physical supply constraints and genuine demand. We can't build fast enough. Customers are lined up. The market bought it. Amazon spiked more than 10%. AWS grew 37% year over year, its fastest cloud growth since 2021. Even as Andy Jassy hiked the full-year CapEx forecast all the way to $220 billion and watched free cash flow go negative $7.6 billion. Think about that. Amazon spent so much that it burned through cash, and the stock went up 10%, because Jassy convinced everyone that AWS demand justified every dollar. He said the AI and chips businesses each cleared run rates north of $25 billion. The market heard the spending has a customer and rewarded it. Now the losers. Same sector, same thesis, same AI story. Alphabet fell 15%, 15, on a quarter where Google Cloud grew 82%, 82, and it still got hammered, because the market got scared by a $15 billion bump in projected CapEx. And Meta dropped almost 10% after it missed on earnings, reporting EPS of $6.18 against a $7.17 estimate. Why the miss? Legal expenses, severance from laying off 8,000 people, and depreciation from all that AI hardware it's been buying. And here's the number that should stop you cold. Meta's free cash flow collapsed from $8.5 billion to $784 million in a single quarter, because $31 billion in CapEx ate almost all of its operating cash flow. The AI build-out is literally eating the company's cash faster than the company can make it. So look at the divergence. Same industry, same buzzword. Every single one of these giants grew revenue more than 10%. Every one. And the market rewarded 2 of them and dragged the other 2 out behind the woodshed. What nobody wanted to say 6 months ago is now the only thing that matters. The market has stopped accepting we're spending on AI as a reason to buy your stock. It now demands we're spending on AI, and here, specifically, is the money coming back. Trading Key said it cleanly. The standard for getting market credit has permanently risen. The magic word stopped being magic. And I think that's simultaneously healthy and dangerous, and let me tell you why both are true at the same time. It's healthy because for 2 solid years, these companies got to treat CapEx like a spell. You'd announce a bigger data center budget and your stock would go up. which, if you stop and think about it, is economically insane. You were being rewarded for spending more money with no proven payoff. That's not investing, that's faith. And that had to end. Fine, good. Adults are back. When four companies are all, as one venture investor put it, holding hands and jumping in to spend together, and the market suddenly turns on capex all at once, you don't get an orderly, polite correction. You get a stampede for the same narrow exit. And you can already see the cracks in the foundation. In the picks and shovels stocks, the Philadelphia Semiconductor Index, the chip makers, the ones who sell the shovels to everyone digging for AI gold, was up 101% through the first half of the year. Then it lost 17% in July, its worst month since June of 2022. When the shovel sellers crack, it's usually because the market has started to smell that the gold rush got way ahead of the actual gold. And then there's Apple, sitting in the corner doing the exact opposite of everyone else. Apple barely spends on AI capex at all. It partners with model developers instead of building the infrastructure. And for a while, the market rewarded it for that discipline. Up 15% in July, its best month in 3 years. Revenue of $109 billion, iPhone absolutely crushing it. Tim Cook calling it their strongest June quarter ever. But, and this is the twist, even Apple got dinged after hours on a China revenue miss and softer services numbers. So the real lesson of the week isn't spend, and it isn't don't spend. It's that the free ride is over for all of them, no matter which strategy they picked. My take: we are watching the AI trade grow up in real time, and adolescence is violent and ugly. The companies that can show $1 coming back for every dollar going in are going to survive this. The ones running purely on narrative are not. And here's the genuinely unsettling part. Right now, nobody actually knows for certain which company is which. Not the analysts, not you, not even the CEOs signing off on the $700 billion. What happens to the entire market if it turns out that $700 billion was early? Not wrong, just early. Because early and wrong feel identical on the way down. Hold that thought. Now, I want to shift completely to something that has nothing to do with money and everything to do with what we're willing to risk to prove a point about ourselves. Nirmal Purja is dead. If you've watched Netflix at all in the last few years, you know him as Nims, the star of 14 Peaks, Nothing is Impossible. The Nepali-born former British Special Forces soldier who, in 2019, climbed all 14 of the world's peaks, over 8,000 meters in just over 6 months. The previous record for that was roughly 7 years. 7 years. He did it in 189 days. On Thursday, July 30th, an avalanche struck his team on Broad Peak in Pakistan, the world's 12th highest mountain, 8,051 meters. And by Saturday, his company, Elite Exped, confirmed he was gone. He was 43 years old. And he was not alone. 10 climbers died in that avalanche. 6 of them Nepali, and the rest from Pakistan, Oman, the United States, and China. Here's the setup for why he was even up there. Persia had already done the 14 peaks. That was the whole documentary. He was going back to Broad Peak this summer, chasing something almost nobody on Earth has done. Climbing all 14 8,000ers a second time, and this time doing it entirely without supplemental oxygen. If he had summited Broad Peak, only one mountain would have remained. He died reaching for a record stacked on top of a record. And this is where the coverage gets interesting to me. Because almost every outlet, CNN, Al Jazeera, the Kathmandu Post, leads with the inspiration. And to be fair, they should, because a lot of it is real. The Nimsdai Foundation called him a leader who showed millions that human potential is far greater than we imagine. Nepal's prime minister said the deaths shocked the entire nation. The man came from a 16-year military career, was the first Gurkha ever accepted into the elite special boat service, took that famous 2019 photograph of the traffic jam of climbers waiting on Everest that went around the world. He genuinely reshaped how the planet sees Nepali climbers, the people who for generations did the deadliest work on these mountains while foreigners collected the glory and the sponsorships. That legacy is not marketing. That part is earned. but I'm going to say the harder thing. Because I think actually honoring someone means telling the truth about how they died, not just how they lived. There's a version of the nothing is impossible philosophy that is genuinely beautiful, and there is a version of it that has become a marketing slogan for a commercial expedition industry that keeps sending more and more people into what climbers themselves literally call the death zone. 10 people died on one mountain on one single day. Persia was leading a group up there, and the same relentless superhuman drive that made him extraordinary is the exact drive that had him back above 8,000 meters, chasing a second lap without oxygen, on a mountain that has killed people for as long as people have climbed it. Now, I'm not saying the man was reckless. By every credible account, he was one of the most capable human beings to ever touch those peaks. What I am saying is this: nothing is impossible is a gorgeous thing to put on a movie poster, and it is a genuinely dangerous thing to build a business model on, because the mountain does not care about your narrative. It does not care about your record, your sponsorships, or your self-belief. An avalanche is not a metaphor you overcome with positivity and grit. It is physics. It is snow and slope and gravity, and it is completely indifferent to how inspiring your story is. And tonight, 10 families are grieving because of physics, not because anyone lacked belief. So here's where these 3 very different stories quietly rhyme, and why I put them together. A Fed that won't admit it might be behind the curve. A tech sector that spent $700 billion on faith and is only now being forced to show the math. And a mountaineer whose entire brand was that limits are an illusion, right up until one of them wasn't. Every single one of these is a story about the gap between the story we tell ourselves and the reality sitting underneath it. And the market, brutally, expensively, in real time this week, is closing that gap on the Fed and on big tech. The mountain closed it on Broad Peak. So here's what I actually want you to think about tonight, and I mean genuinely, not as a rhetorical flourish. In your own life, where are you rewarding the narrative instead of the return? Where are you calling drift discipline because admitting you're lost is just too hard to say out loud? Because the market is learning that exact lesson this week the most expensive way there is, and it's a lesson that, in the end, has nothing to do with money at all.